Pump and dump. This is one of the most common scams in the stock market. It usually starts with hype. Maybe a TikTok influencer, Reddit group, or Twitter account pushing a small, unknown stock. They'll say things like, "This stock is undervalued," and "It's going to the moon." People rush in. The price starts rising fast. But here's the trick. The people who started the hype already bought in early. They wait until the price is high, and then they sell everything for massive profits. That sudden sell-off causes the price to crash. People who bought in late and were part of the hype are left with nothing. They lose most or all of their money. Real example. In 2021, the stock GameStop was pumped nearly 8,000% in a matter of days. While some early investors made huge profits, others bought in at the peak. When the hype cooled down, the stock dropped by over 70% in just days, and regular investors lost big. Rug pull, crypto addition. This scam is super common in the crypto world. It starts with a new project, a crypto token or NFT that looks exciting. They launch with a polished website, maybe a roadmap, flashy branding, and sometimes even paid influencers or celebrities talking about it. Early investors jump in. The price of the token goes up as more people buy. But what you don't see is this. The developers control the money pool, called liquidity. And once the value gets high enough, they pull all the funds out and disappear. That's called a rug pull, like someone yanking the carpet out from under you. You're then left with worthless tokens and no one to contact. Real example, the Squid Game token in 2021 used the popularity of the Netflix show to hype up the coin. People were buying in, and the token price shot up to over $2,800. Then, the developers drained the liquidity, deleted everything, and vanished, stealing over $3 million in crypto. Ponzi Scheme. You might get approached by someone who seems trustworthy. Maybe they wear a suit, show you big returns, and say it's a low-risk investment. But here's how it works. New investors' money is used to pay the returns for older investors. Everyone is happy at first, but there's no real business or profits. It only works as long as new people keep joining. Eventually, the scheme runs out of new recruits, and that's when the entire system collapses. Everyone who hasn't cashed out early loses everything. A real example is the biggest Ponzi scheme in history, Bernie Madoff. He ran a so-called investment firm that claimed steady profits for years, but it was all fake. He used new clients' money to pay old ones and faked reports to cover it up. When the 2008 financial crash hit, people tried to withdraw money, and the whole scam unraveled. Over $65 billion was lost. Print and drain. A small public company keeps issuing new shares to raise money, but every time they do that, your share of ownership gets smaller. That's called dilution. This causes the stock price to decrease. To avoid looking bad, they do a reverse stock split, combining shares so the price per share looks higher. But then they issue even more new shares again, further reducing the stock price. Whenever investors try to buy into the stock, they are trapped in the constantly decreasing stock and either have to sell for a loss or lose all their money. Real example, a company called Bollinger Innovations has done over 30 cycles of the print and drain cycle. People who held on saw their original investments become practically worthless due to the continuous dilution. Boiler room scam. You get a call from someone who sounds sharp and confident. They say things like, "This is a limited time opportunity," or "Only smart investors are getting in." They pressure you to act fast, maybe even insult you if you hesitate. But what they're really doing is pushing fake or worthless stocks, often ones they or their friends already own. Once you buy, the price might temporarily spike and then crash when they sell. A bit like a pump and dump scheme. Real example. This is exactly how Stratton Oakmont operated. The real-life boiler room made famous by the Wolf of Wall Street. They scammed people into buying junk stocks, made millions, and left everyday investors in ruins. Fake TikTok investing gurus. They look rich. They flash luxury cars, vacations, or show huge wins from secret trading strategies. They say, "Join my VIP group," or "Buy my signals. You'll make six figures too." But here's the truth. Most of them don't make money from trading. They make money from you. They're selling you overpriced courses, expensive memberships, and fake dreams. Real example. In 2022, several TikTok and Instagram influencers were caught faking trading screenshots using edited apps. They also rented exotic cars just to make themselves look more successful. Fake trading platforms. You find a site or app that looks legit. You deposit money, start trading, and see your balance grow. Charts move, orders go through. It feels like a real platform, but it's all a simulation. The platform is fake. When you try to withdraw your money, nothing happens. No support, no reply, and your money is gone. Real example. The Gain Bitcoin scam was a fake crypto trading platform. People saw profits but couldn't withdraw anything. Over $5 billion was lost. Celebrity deepfake scams. You're scrolling online and suddenly see Elon Musk, Mr. Beast, or Warren Buffett in a live stream or video. They say, "Send us crypto and we'll double it." It looks real, but it's not. These scams use AI voice cloning, deepfake videos, and hacked accounts to trick people into sending money. Real example. In 2023, fake live streams of Elon Musk ran on YouTube and Twitter promoting fake crypto giveaways. Thousands of people sent in Bitcoin and never got anything back. The moral of the story: if anything looks too good to be true, it probably is, and you should run away from it as fast as you can.